dissenters since 1992. What do you think of that?
I would have said, this is really shocking news in the event that those three dissenters, in addition to Myron, wanted to have rates cut or rates hike. But they gave some vague answer that they didn't think there should be an easing bias. So I would have liked to have had those three other dissenters take a stronger stand in one direction or another if I was really to be shocked by this latest Fed policy statement. There is some dissent, and it could be that Warsh may have some difficulty trying to get a rate cut. Maybe that was the message. If Warsh comes on board in the middle of May and he attempts to get a rate cut when inflation is still well above 3%, and when the unemployment rate is relatively low, when initial claims for state unemployment benefits are near historic lows, he may not be able to persuade the majority of Fed FOMC members to go along.
Yeah, and Beth Hammack, Neil Kashkari, and Lori Logan backed holding rates, but opposed adding any easing bias to the statement. I think it's very interesting, and the concern here is that inflation and costs can affect our middle income, lower income households a lot, right?
Correct. And I would think that if we're going to have...
war? I mean, what if it keeps going?
Inflation will remain elevated. If we were to go ahead and have the retail price of gasoline average more than $5 per gallon for 2 months, I think the risks of a recession would be very real. But if costly gasoline, costlier fuel, and other products cause consumers to cut back on spending, then we're bringing a recession into play. If consumer spending is less than what businesses expected, we will be looking at an accumulation of unwanted inventories. We'll be looking at an underutilization of staff. Companies will have to start laying workers off, and that it'll force the Fed to go ahead and cut rates. Who cares whether or not inflation is still above 3%?
There's an article saying that this opens the door for Powell to peacefully depart. Is it time for Powell to go, especially when you have a mixed committee like this?
Well, if he stays on, I would think that he would rather depart. He would, rather leave. But you never know. I can't roll it up. But you're raising a great point. If he decides to stay on, then Kevin Warsh is going to have all the more difficulty trying to get the FOMC to vote for a rate cut, which his big boss, Donald Trump, wants so badly. I'll add another thing. We often forget that when this current series of rate cuts began back in September of 2024, the 10-year Treasury yield was at 3.75%. Well, guess what? Despite the fact that we've had, I think, about a 1.5 percentage point cut in Fed funds, the 10-year yield today is higher than it was back in September of 2024, 4.4% instead of that old 3.75%. Rate cuts offer no guarantee, no assurance that long-term Treasury yields decline, and long-term Treasury yields might increase, and that would make matters even worse for home sales.
Yeah, and look, stocks continue to move lower here as Treasury yields did move higher on the news initially. Right now, we are basically just hit the session lows. We were at 71.08. We're at 71.13 now as we're wrapping up our interview. But as I watch the tick by tick here, minute by minute, you are seeing some pressure here on the markets. John Lonsky, I love seeing you. Always a great time to talk to you. I really appreciate it, of the Lonsky Group.
You're here, Nicole. Keep up the great work.
Thank you, John. Okay, Art Hogan from B. Riley will join us next to break down the FOMC decision, preview Jay Powell's press conference, because that's coming up at the bottom of the hour. What will people really be listening for? We know that they've talked about elevated inflation, and of course, we're in this low hire, no fire job environment. What happens next? I'll ask Art Hogan.
My parents didn't really talk about money at all. In college, everybody around me had money. I didn't want anybody to find out that I wasn't middle class. I was using credit cards to do anything and everything. I ended up with $20,000 of credit card debt. That's when I kind of realized, like, all right, I have a money problem. This is about how my finances got wrecked and how I fixed it. And if I could do that, you can do it too.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange, where stocks dropped to the lowest part of the session today, right after the Fed announcement of keeping rates unchanged. You had 4 dissenters, 8-4. We haven't seen that since 1992. Art Hogan, Chief Market Strategist, B. Riley Wealth Management, is with me now. I mean, Art, when it crossed, and I had to say it at 2 o'clock, I got to tell you, I was rubbing my eyes and saying 8-4 unchanged. I mean, I almost had to question. You and I have been on Wall Street for a zillion years. Well, not a zillion, okay, maybe a few. But you know what I mean. 8-4, you don't see that.
Yeah, I think a couple things to think about there, Nicole, and you're right. That was a shocking number of dissents, and you have to go back to 1992 to see 4 dissents. Things were very much different at the Fed back then, but just understand, I think John Lonsky, my buddy, who referenced that as being 3 Fed governors are weighing in on what they think about rate cuts, which are really something that the new chair would like to move forward with. They're just setting the table up here for the new chair to know it's not going to be easy. And the Fed is set up that way. It's done by committee. That's why we have votes. That's where you have to have a majority of votes. So although we have one governor who's been on autopilot and dissenting for a rate cut since he joined the board, it's important that the new chair knows that, yes, he's going to make it in. He'll get it through Senate. He'll be the new chair. But things are complicated in the economy right now. And to come in and think it's a good time to be cutting rates is probably the wrong way to look at it. As a matter of fact, we may not see a rate cut for the rest of this year. That's all dependent on how long this war lasts and how long supply chains through the Strait of Hormuz are clogged up. But I certainly think that was a little bit of chin music or a messaging by 3 governors to say, careful what you wish for. You may be the chairman of the Fed, but you're not necessarily going to get everything you want.
Yeah, and look, Warsh was already there. He was there 2006 to 2011 as a central bank governor. He was the youngest at that time, 35 years old. So it was he had been on the Economic Council for Bush. And so he has a long run here. I think people think that he will try to be fair and independent and all that. There is pressure on him to cut, though. You think he cuts? You think he goes rogue and says, listen, we need a cut for small businesses or for whatever other reason. Let's put a cut in place between now and the end of the year?
Well, I think that you could certainly make a case for a cut, but you're going to have to get to the other side of this war first, right? So, we need to be at least near the off-ramp to this war, and we need to see that the core inflation hasn't picked up a lot of the headline inflation, meaning the increased price in per barrel of oil, all of the hydrocarbons, all the petrochemicals haven't flowed through to the core inflation, so much so that it's moving too far away from target. To make that argument, this war has to be over in a month and not in a couple of quarters. That's one piece of the puzzle. But the strength of the labor market, so the last time the Fed cut in the fall was in a very deteriorating labor market. Right now, we've kind of stabilized there. And although we're only creating about 25,000 jobs a month, that's not moving unemployment that much. So to the extent that you're defending one of your mandates that's actually in pretty good shape at the risk of the other mandate, which is clearly in trouble, at least at the headline level, will be a hard argument to make. It's not impossible that things will calm down, we'll get out of this Iran war, and we'll be able to say the argument for making a cut makes sense now, but that's not until the 4th quarter of this year.
Yeah, Bitcoin also dropped. I thought that was interesting as well. Went to the lowest of the session, as well as stocks. I mean, the last cut was last fall. This is the third time they're holding steady. At this point now, when you think about the outlook for rates, and, you know, we did get some good pieces of news. We got three pieces. They were saying, you know, is the Iran war actually helping the market? And there were three pieces of news. I think it was housing and durable goods and one other thing that really showed that the economy was doing okay.
Yeah,
So
consumer
where do you
confidence
think
yesterday too. Yeah, consumer
Yeah,
confidence
right. And
yesterday.
so
You're right.
consumer
Retail sales
confidence. So
last
what's
week.
going
Consumer
on?
confidence, durable goods. Yeah. So what's going on is fundamentally the economy is in good shape entering this war. And I think that's one of the reasons that the drawdown has only been a little bit less than 10%. I think, you know, think about where we were before this war started. We had the yield on a 10-year below 4%, gasoline below $3. You had earnings estimates for 2026 in low double digits. Now they're at mid double digits. So the fundamental backdrop has been relatively strong, and I think that's been supportive of equity markets. The only issue here with all of that is how much of that deteriorates and how much degradation do we get in the fundamentals the longer this war lasts. And I think that's what the Fed has to be careful of. And I think they're very conscious of the risk of this getting worse before it gets better, unless and until we find an exit ramp here and start focusing on the things that are really driving it. A lot of what's driving the stronger earnings is coming from CapEx spend for artificial intelligence. We're going to learn more about that tonight.
Yeah, and that's part of it too. You know, the question too was about hiring, firing, and the job picture, and whether or not AI was being used as an excuse not to hire.
That's a really good point.
What do you think about that?
That's a really good point, Nicole. When you think about the cohort that is that 24 to 30-year-old, that's the highest of the unemployment rates. When you think about that, you know, just out of college, getting that first job, and I think that slow to hire has been an unintended consequence of companies starting to use artificial intelligence, or at least leaning into it such that they don't overstaff at the front end of this. So I think it's going to be a while before we understand the transition we will have to go through with large-scale adoption of artificial intelligence. I certainly don't think we're there yet, but I think that uncertainty around both the war and the adoption of artificial intelligence has put us in a place where, while we're very slow to fire in corporate America, we're also very slow to hire. And that's put us in a place where our monthly job reports have been something like 25,000 a month.
What do you think would be the range? I think we were just talking about 375 at one point. The range of the 10-year bond yield in the next 6 months. What would be the low end and what would be the high end, do you think?
Yeah, well, we were heading to a place where, you know, 3 3/4 to 4 1/4 made a great deal of sense. We're up at 440 now, pushing up against the recent resistance level. And the reason for that has everything to do with what we just talked about in terms of the inflationary pressure of higher energy prices. So I think to get that range back down to where it'd be a healthier place for the housing industry and, you know, for overall credit and demand for credit would be the end of the war, a big piece of that. Understanding better the adoption of artificial intelligence and how much that is improving in real-time productivity, that would be another piece of the puzzle. If, in fact, we have a better understanding of that after July 4th and heading into the fourth quarter of this year, I certainly think yields on 10 years could start working their way down. And I think that's, you know, that's incumbent on a couple of large things happening. A, realizing and seeing real live proof of productivity increases, which we've started to see, and actually seeing commodity prices start to come down.
Right. All right. Art Hogan, great to chat with you, Chief Market Strategist at B. Riley Wealth Management. Nice to see you, Art. Thank you. Coming up next, Jay Powell's opening statements. And
Hold on, I'm gonna see something here really quick. I want to see if I can add. I'm gonna see if I can add the chart right here on the screen with y'all really quick. Hold on, let me see if I can add. Blah, blah, blah. Boom. Let's see if I can add what Webull. It just kicks me out. Sorry guys, just give me 1 second here. Did this not work? Alright, never mind. Sorry guys, it's just not working.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months. Inflation has moved up and is elevated, in part reflecting the recent increase in global energy prices. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. Job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over, with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well. As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
Sure. So, my concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was that?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. As I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think, left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick.
Chair Powell, if I could ask about the inflation outlook. In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags, so you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate, and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation's 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because what happens in the next 30, 60 days, even by the next meeting, could really change the picture around that language. So, it's a much closer thing on the committee than it was in March, and that makes all the sense in the world, it seems to me.
Claire.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias, we've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership's going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
Thank you. Just to follow on, the new leadership also seemed rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools? So
I'm not going to give him any advice through you today here, but I think communications generally is. I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be looking at new things. And if that happens, it feels like it's going to happen. That's a completely appropriate thing.
Neil.
Hi, Chair Powell, Neil Irwin with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was. We were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up: is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Chris.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market, and should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many, many reports were going to people at the bottom end of the income spectrum. And we had many, many reports of, I mean, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out, and it was a very healthy sort of set of societal dynamics. So of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very, very similarly all over the world. It had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and we for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
And just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or what else?
I'm waiting, for the investigation to be well and truly over with finality and transparency, and I'm waiting for that, and I will leave when I think it's appropriate to do so.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. I'd like to ask you if you could explain a little more or characterize a little more the discussion about the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
So nobody, the three dissenters and others who could have supported that, and others who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, it's a form of forward guidance, and you don't want to make them in a way that will be sustained and continue to make sense, and not something you need to take back fairly quickly. So I think we just a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument too, as I mentioned. I mean, it's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got 3 dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking, and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Howard.
Thank you, Chair Powell. Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can. Touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but I was brand new at that time, so I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily, and that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be, they won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, there were elevated concerns about the bleed into core. And, here we are with 3 dissents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and they're real, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable, because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know until we know. So fortunately, we're in a good place to wait and let things develop.
Thank you.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with SEPs. Can you talk about why you see that as a net positive?
So we always said, when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, you know, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings, and doing that without a press conference, I think, would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to, and I do think it's quite helpful to, you know, I mean, I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message, and it's, you know, it's going to be all over the place because we do, thankfully, have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented action, any action on those changes?
So yeah, I'm not going to go into the real small specifics, but what we found very quickly was that making changes, making really large changes, for example, to the dot plot or the SEP, it didn't have, we couldn't come up with anything that had really broad support on the committee. And so we just moved on. We didn't really do as much on that as we might have. And you know, I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And you know, we've looked at a bunch of things, and you know, it's something. Like I said, I think every new chair is going to look at our suite of communications, and think about what would be changes. We are the only major central bank that doesn't publish a forecast, and that's because we have a 19-person committee, and you know, you try to do that at the board, that's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the New York Times. If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
You know, where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then, or if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now. So it really is going to depend on how things evolve, and you know, that's really where it is. As I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You know, you just have to find that out empirically. You know, given our the fact that we're, you know, a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s, you know, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is you know, a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I've mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
You know, the neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it, you know, between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. You know, I think the labor market is still probably cooling off just a little bit, and I don't think there's much of a case for any case really for policy looking, you know, meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992, are you handing off a divided Fed?
You know, the thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, you know, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? You know, it's the central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. You know, people are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And it will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets, so they're going to spend less on other things. So there will be a hit to GDP. So it's a question whether spending goes down to offset the inflationary effects. So it's not the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
And the message it sends to President Trump by staying on?
I'll stand on what I said earlier.
Victoria.
Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law. But it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to respect those, continue to respect those boundaries. about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy, so we've resisted that.
Well, and maybe another way of asking it too is, do you think that Fed independence is as strong now as when you became chair, and if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about, and we've had to do that, and we've been successful so far. But that's not over. None of that is concluded yet, and it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it, and I'd like to think that we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect perfection, but do expect us to make, decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves, but there are widespread concerns that these things may continue. That's all I'll say, and and that would be a problem, and so.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. Do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to, to consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient, and Chris Waller is particularly passionate about that. Of course, so are the presidents, and it's a question of how do you accomplish it. We of course, and Chris said this in his speech, we want 12 strong, independent central banks with their own staffs and their own monetary policy views and all that. But there are things that are done in all 12 which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that, but everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy. And I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Christine.
Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right, I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
We're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs, and the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of job loss and things like that, but we try to get there over time in a way that does the least damage possible, and our commitment to that is never-ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing. If I can have that amendment, yeah, growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's in a sense, the labor market is in balance. But it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. Inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly. And we'll just have to see how that works out. In the meantime, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think, there's a lot of signaling going on when you change guidance like that. And so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now. But maybe it'll come to that. And the reason is because, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it, and of course we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this. I'm not looking to be, a high-profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. You've made many tough decisions in your time at the Fed, and as your time as chair comes to a close and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, all of us together have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years, and that's just a very different situation than for a very long time. What the Fed and other central banks were doing all the time was demand management. And there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging, and we've tried to do our very best through these really challenging times, and I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against Lisa Cook or the Fed in the future decides to make decisions more around the political calendar instead of the economic data?
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that don't think about an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations, completely ignore them. This isn't bipartisan, this is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, oh, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone. And let me say, whatever people say, the markets believe in that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Okay, we'll go to Richard for the last one.
Thank you, Chair Powell. Richard Escobedo with CBS News. We've talked a lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. People are still spending, and how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, and certainly none from this. But you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy, so we're not like a European country where 50% of the external of GDP is in the external sector. We're also, as I mentioned, we're an oil exporter, so we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
Well, it's kind of, one of those things you don't see it until it actually happens. But certainly in the Midwest, agricultural farmers are feeling the burn of higher fertilizer prices that they are paying now, because that's already being reflected in current commodity markets through the higher costs, input costs. So that is coming through, but you're right. For the time being, inflation is, maybe just above 3% on an annual basis, but we do think it could get up to 4% annually over the coming months.
So I just wanted to clarify as well, with obviously this view that the next move could potentially be a hike, but then we're also talking about the potential for higher energy prices over the summer causing some demand destruction. I mean, where's the balance there? I mean, do you think the higher oil prices could create enough demand destruction for the economy to at least ease the inflation front itself, so that the Fed doesn't necessarily need to hike? I mean, how are you watching that tricky balancing act right now?
Yeah, I mean, the way we talk about it is different scenarios. So we did put a worst case scenario out there of crude oil actually hitting $200 a barrel.
By?
200 by later this year.
Okay.
And certainly that would create demand destruction, but with these scenarios, we do attach probabilities. So we think that pessimistic scenarios probably got a 30% probability. So 70% that doesn't happen. And certainly oil reaching that high could provoke a recession in the U.S. And again, 30% probably a recession in that $200 per barrel scenario.
Okay.
So recession risks are elevated than they would otherwise be.
Okay, and obviously everyone's looking at that duration, particularly because if we're going to have an extended blockade, that's going to be something that everyone's watching as well with triple-digit oil once again. Ken, really appreciate it. Thanks so much for joining us today and getting your reaction to the Fed. Ken Kim there, senior economist, senior director over at KPMG here on the floor. Coming up next, we'll have more Fed reaction, and we'll talk about where stocks can go from here next on Market on Close.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Caden alongside Sam Bottis in New York. Another tech company reporting earnings this afternoon will be Qualcomm. Estimates calling for adjusted EPS of $2.57 on revenue of $10.62 billion. Earlier this week, it was reported that Qualcomm is partnering with OpenAI to develop specialized processors for a new AI-native smartphone slated for 2028 production. Now, we've been talking about these 4 of the Mag 7 names we'll be hearing from today, but they are not alone as the only names reporting today. Lots of earnings today. We've got Chipotle later today, Ford, Carvana, KLA Corp, eBay, Qualcomm, just to name a few of the other names that we are going to hear from today. And of course, if any of these make considerable moves, we'll highlight them for you. But the focus after the close will be on those Mag 4 names. I do want to send it back to Sam in New York, who is live on the floor of the NYSE with our next guest.
Thanks so much for that, Marley. Well, I am joined here on the desk by David Bush, Co-Chief Investments Officer over at Trajan Wealth. David, always nice of you to join us, and particularly on a busy day. I suppose the big question is where stocks go next, and that's all going to depend on the 4 biggest companies of the planet, or at least 4 of them, this afternoon. What do you think happens?
That's right. Yeah, it's been a fascinating day in the markets. I mean, one of the biggest days that we've had in a long time, given the Fed decision, the war in the Middle East, and 4 of the Mag 7 companies reporting earnings today. So we've got a combination of Facebook, Microsoft, Amazon, and Google all reporting this afternoon. So it'll be interesting to see how they've progressed towards monetizing that AI, and can they show profitability given the AI CapEx that they've announced over this last year.
What happens in a scenario where one performs well, one performs not so well? Which route does the market take?
That's a great question, and what I think is those 4 companies alone represent 15% of the market cap of the S&P 500. So even one of them, if it starts to sell off, is going to have an impact on the index as a whole. But I think what will end up happening is similar to like what we saw with search engines from the late 90s and early 2000s, that there's going to be some that come out as winners in this space. And now all of them have different revenue streams available to them, but I think ultimately the AI race will come down to a handful.
Is there a particular one that you're most excited or looking more keenly towards hearing from?
I'm really fascinated with a combination of Amazon. One, because we still need to figure out, we need to determine like what their cloud infrastructure is going to look like, and if there's an impact in Iran with the war in Iran. But Microsoft with Copilot, that's going to be fascinating to me because Copilot for me is the least used out of all the AI technologies that are out there from my perspective.
And you personally?
Me personally, yeah.
Oh, interesting. Okay. Yeah, I know that one of the metrics is going to be very closely watched around the co-pilots. How many seats, obviously, they're going to update the market with.
That's right.
So that's obviously going to be very interesting. As far as the overall market performance is concerned, obviously we made back all the Iran war losses. We got back to the all-time highs. A lot of that has been driven by the growthier parts of the market once again. I mean, technology was back in the driver's seat. But then we get to a situation where obviously we're in a bit of a holding pattern ahead of what we hear from with these Mag 7 members. But you've got Trump saying they're preparing for an extended blockade. You've got WTI back in triple digits. I mean, how much more can the markets take? Because they seem to have been pretty good, pretty resilient in the face of things at sort of shrugging off all of this and kind of thinking that this is all going to come to an end. But, I mean, can we keep going?
Well, that's kind of the question that we have. I mean, essentially, even if the blockade ceased today and there was a peace treaty in place, the infrastructure that was destroyed during this war, it will take months to rebuild. And so we're in for at least an intermediate term before oil prices can come back down. Having said that, if this thing extends further, it's going to impact the consumer more and more because we see the pinch at the gas pump. We're seeing higher oil prices bleed through the rest of the economy, and it will. I mean, everything is sort of dependent on energy, and so it'll continue to impact the U.S. economy.
Is this going to be more of a sort of second half of the year type story, do you think, when we start to see that demand destruction? I mean, I was just speaking to that economist from KPMG. I mean, he seems to be in the camp that, while we will see some degree of demand destruction, he believes the next move from the Fed could be a hike because of the inflation headwinds, blowing towards this country. But I'm just wondering, because the earnings are holding up. I mean, as I mentioned earlier, I mean, Brian Nichols saying they're still going out and buying expensive frappuccinos, even though they're paying, $4.20 at the pump. Right. I mean, where is the disconnect here? Because we keep talking about the potential for the consumer to be impacted, but the earnings profile looks good. The fundamentals are holding up. We're talking about this productivity boom that's going to be, as Walsh thinks, disinflationary, but everyone seems to think that's going to propel growth this year.
Yeah, and I think that's the key is that it has to work its way through the system.
Yeah.
So we're seeing higher gas prices, but also the cost of consumer goods is going up, and we're seeing that reflected in the PPI metric earlier this month. CPI jumped, headline CPI jumped 1%, but it's all due to this higher energy prices. So in my mind, what's going to happen is we're going to have demand destruction over the next several months and quarters because of those higher prices, especially if we look at yesterday's Visa earnings call. Credit card usage is still elevated. So now you have consumers that have higher debt balances coupled with higher prices of goods.
And what's that going to mean for markets? I mean, are we going to continue to see that dispersion between the AI companies once again pulling ahead while some of the more value type areas of the market get kind of left behind because of that? Because we came into 2026 with kind of like the opposite, this whole narrative around the optimism of this sort of broadening out theme and the sort of the more cyclical kind of boring parts of the market actually performing quite well.
Yeah, so in my mind, it's large cap tech is going to continue to to be the wave of the future. The traditional value sectors, I think, will do well given the AI infrastructure build-out. So those sectors that are going to be responsible for that,
like industrials, utilities,
materials, all of those. In terms of consumer, between consumer discretion and consumer staples will likely outperform versus consumer discretionary because of that inflation impact. But I think from my perspective, we have to get back to fundamentals and diversification between growth and value. And even with fixed income, I know yields are higher today, but it's fixed income is an asset class to invest in and can provide diversification and less correlated assets.
Yeah, for sure. I mean, it definitely creates a little bit of a buffer within the portfolio. So where are some of the opportunities you're looking at right now with so many moving parts, so many uncertainties? I mean, everyone keeps forgetting we're also in a midterm election year.
Yes, we have that as well. So energy, industrials, materials, again, that AI infrastructure narrative, consumer staples versus discretionary, and then large cap tech. They're going to continue down this path of AI, and now it's up to them to monetize that technology and to monetize that CapEx spend essentially.
Yeah, I mean, we'll get some signals and at least an update on that this afternoon. Really appreciate it, David. Thanks so much for joining me around the desk today. That is David Bush, their Co-Chief Investment Officer over at Trajan Wealth. Marley, I'll send things back over to you in Chicago for now.
Thanks, Sam. Coming up next, we've got Options Corner. Rick Ducat will be joining us here in our Chicago studio to take a look at the options activity on Amazon ahead of its earnings after the bell. That's next on Market on Close.
Man. Hey!
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Hey, Pop.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim's my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time.
Welcome back to Market on Close. Amazon is among the Mag 7 names reporting earnings after the close today, with expectations for adjusted EPS of $1.60 on revenue of $177.84 billion. Investors will be focused on AWS growth and whether or not the company will have to add to its CapEx estimate of $200 billion for the year. Shares are up almost 25% so far this month, and this is, of course, our focus for Options Corner today. I'm here with Rick Ducat, our lead market technician, to take a closer look at Amazon in advance of those earnings that we'll have right as the bell rings today. And Rick, as we look at Amazon, and talk about this name more broadly against the broader market, how has it been performing? Because I did just highlight that rally we've seen over the past month.
Well, just hit some all-time highs recently. Amazon up about 40% during the year. S&P only up about 28.2%. Meanwhile, the consumer discretionary sector showing a bit of a different path here, trending downward while Amazon trends upward here, only up about 17% as well. One other thing to point out too, Amazon and the S&P very tightly correlated right now. Kind of a theme I'm seeing across the board here for many of these big companies. They're moving almost in tandem with the broader market, perhaps because they make up so much of these indices here. So look for any breakdowns in these relationships with some of these big earnings that we see today for maybe some trading opportunity clues.
And as we look at Amazon, and its performance standing by itself, what are we seeing there in the technical setup here?
Right. And kind of as you said, it's like, will enough be enough for these companies here? Will the earnings be enough to justify the CapEx and the AI spending, as well as will the guidance be enough to make it worth it going forward as well here? So as we said, Amazon intraday highs today, 265.91, 254 to the downside represents our old best close from back in that area. A bit of chop here, but we haven't really convincingly retested that area since we pushed back above it here. So we'll have to see how that plays out. If earnings do disappoint, we move to the downside. A short-term trend line, beginning with this gap that we established here, is one trajectory that you could draw. Oftentimes it makes sense to restart trend lines after any kind of gap to the upside because they often represent some kind of significant fundamental change or some other piece of news information here. So other levels to the downside include this gap near 240 and this gap near 234, which incidentally is where our downward sloping trend line in blue there was breached. So now if we were to consider some of our moving averages, we're pretty close to our 5-day EMA in dark blue coming in just below 260. We have our teal 21-day 244 roughly there as well. That could provide another supportive area. RSI is a little curious here because on one hand we broke through our trend line, we've started to move more sideways, but we're still overbought. We're still showing a reading of 75, so still very elevated as we approach earnings. So look for that to be more of a breakdown symbol, a bearish signal if we do push below that 70 level. Finally, our volume profile study shows that we have a smaller node here, 243 to about 250. That's the most significant one close to our current price activity. But really the important area is all the way down here, 219 to about 230, 223 roughly would be our point of control. That's the very heavy trading area. That's where many traders have probably established positions previously that have since been left behind, but still a notable area to consider.
Yeah, certainly left behind. We're about $40 higher than that area right now, and today trading up just under 1%. But as far as the options action that we're seeing on this name with the earnings coming today, are we seeing an uptick?
Yes, so the sizzle today is 2.52, so 2.52 times the 5-day moving average of options volume here. We can see our expected move for this coming monthly expiration, about 9% over the next 16 days. 1.1 million options changing hands today. 68% of them were calls. Our most active open interest month, kind of unusual, January 2027. That's the a while out. Typically it's the front month, but it can vary here. Biggest opening trade I saw today, March 19th, 2027, 250 strike puts, minus 2,500 of them for a $6.1 million credit received. So thinking that there's perhaps a notable low point here, pretty close to our current price activity with this longer term trade.
Well, we will soon know in the short term what the market's going to think of Amazon's earnings as soon as we get those, right as the bell rings in just under 15 minutes. But I do want to send it back to Sam in New York.
Thanks, guys. Well, coming up, George Sillis will join us to preview Microsoft earnings as the tech giant has had a rocky start to 2026. So he'll break down all you need to know ahead of this report card coming up next on Market on Close.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com. Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
How's it going? First day, so.
Sometimes, you know.
Next. Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Welcome back to Market on Close. I'm Sam Vardas on the floor of the New York Stock Exchange. We're going to look ahead to Microsoft earnings coming up in about 20 minutes. So let's bring in George Siller, senior markets correspondent, to see what we can expect from the report. We know this has been under pressure since around October. Obviously, shares back to the levels before last quarter's report, George, off the back of that 10% pullback. We then got another, 20% or so drawdown as it got caught up in the SaaS apocalypse. It's made up some, but we've seen that multiple compression. So just walk us through what you know, what we should know ahead of this report card today.
Well, yeah, I mean, I'll start off with that. I mean, if you look at the multiple compression, it's evident in Microsoft. I mean, right now, it's trading around 26 times this year earnings and 23 times next year's earnings. Historically, it's around 31 times. So it's trading already at a discount to historical averages. So there's obviously a margin of safety built into the underlying price. If you look at the EPS, they're estimated to grow over 17.5% to $4.07 compared to $3.46 last year, and revenues estimated to be around $81 billion, up 16%. But I think one of the aspects of the report that I'll also be looking at is the Azure growth. That's expected to be between 37 and 38%, which is quite high. CapEx right now, based on guidance, is around $100 billion. So if they increase that could certainly add some additional pressure to the shares. And I think the cloud gross margins, which are expected to be around 65% of sales, will be also another internal metric that analysts will be looking at. But I think the aspects, too, of SaaS monetization, when it comes down to things like Copilot, average revenue per user on a Copilot basis, as well as what they're doing with agentic AI, is going to be important in terms of their earnings. So this will be interesting because, again, it's trading at a discount to historical averages. If you look at their growth rates, they're actually expected to be quite high at around 21% EBITDA growth next year versus this year. But again, the aspects of why it's trading at a discount could be its relationship with OpenAI, which is tenuous at best. So I think that addressing that relationship also will be an important factor that I'll also be looking for in the conference call.
Okay, so a lot of the guests I've been talking to have pointed out, as you said, that metric to watch out for being Copilot, whether we're starting to see real revenue, because no doubt that'll be some of its way to address the AI disruption fears in this market. And we do need an update on the Copilot seats. Last time, I think the update was 15 million, because that's how it's translating to enterprise, right, as far as those numbers are concerned. Then, of course, we want to know where the spend is going with CapEx, not just about the money, but following the money as well,
Right.
about how the incremental compute capacity has been somewhere where they've been investing. I know they've talked about that previously. So are they kind of the main metrics we're looking out for beyond just the headline CapEx numbers, sort of more of the proof in the pudding as to where some of that is actually going?
Yeah, I think that's what, and also be looking for. They're going to be very detailed in this case, not just the total cloud growth, which I suggest is still quite high, the estimate. So I think it's a high bar, to be honest with you, on this quarter, but they could beat it. But the other thing is, Copilot versus, OpenAI. These are two different technologies that are essentially competing with each other, but at the same time, Microsoft has an ownership stake of OpenAI. So I think that relationship, is very cloudy, a little bit muddy. And I think also, OpenAI may be gravitating more towards Oracle for their cloud hosting services away from Azure. So I think that's another area that could be, provide a relief, honestly, for Microsoft. So I suggest maybe if they divorce themselves a little bit more further away from an OpenAI, that would actually be a good thing for the stock. But I could be wrong in that regard, but I do suggest, again, if you look at Copilot using their products, which most people do, it's everywhere across their products. But again, it comes down to monetization rates of those products, which I don't know what they're going to be reporting on.
Yeah, and then obviously that's going to be an important read on the health of the enterprise software space as a whole, because as we mentioned, this has kind of got caught up in that whole SaaS apocalypse narrative. George, we'll be watching. We'll know in a few minutes. Thanks so much for that preview.
Okay.
Molly, I'll send things back over to you in Chicago for now.
Thanks so much, Sam. We are nearing the end of the session. Alex Coffey will be joining us to break down today's action, and we've got earnings on the way for you from Meta, Google, Amazon, and Microsoft. That's next on Market on Close.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
We are back here on Market on Close. I'm Sam Vardis on the floor of the New York Stock Exchange alongside Marley Caden over in our Chicago headquarters. So we've just got a few minutes left in today's session. It's going to be very busy post-bell. So let's welcome in Alex Coffey, host of Next Gen Investing, to help close out the session. As we're going to skip across the finish line together and get across these earnings, we're going to be hearing from 4 of the biggest companies in the planet, and we're going to be hearing it in very rapid fire type of fashion, Alex. So thanks so much for holding our hands as we do this. I'm just wondering, as far as the market positioning, a little bit of a different picture to what you and I were talking about earlier today. I'm seeing a lot more red on the screen. Obviously, we've got through this Powell press conference. The VIX hasn't budged a whole lot. Just walk us through what you're seeing right now as far as the levels.
Yeah, a few things stand out, and I guess we'll start with volatility, since you mentioned that. Volatility has remained relatively elevated throughout the duration of this rally off the recent lows. So to me, that's indication that there's still uncertainty around geopolitics. There's still uncertainty around earnings. And that uncertainty can be in both directions. So we've gotten back to all-time highs, but where volatility is relative to where we typically have been throughout history on all-time highs, it's in the lower, kind of middle-ish range of that, because, parts of 2020 and 2022, when we recovered, we still had pretty high volatility post-COVID. But all in all, I guess I look at this and say, I'm not surprised that basically nothing that has happened so far this day, throughout today, is ultimately going to be the story when we come in tomorrow, because these earnings are going to be so critical as to what the market's about to do. So today's been about, reacting to the Fed, which did have some surprising elements, and I'm sure you guys have explored throughout the hour, and positioning ahead of these earnings, which ultimately are going to be the juror for what today looks like.
And Alex, as we look at the jurors across the board here, which one is going to be the most impactful? Or which one has the setup to be the most impactful?
Well, I think there's a couple ways to answer this. Microsoft, Amazon, and Alphabet are bigger than Meta. But Meta is the highest beta of the names, and it's also the one that seems to be most aggressively investing relative to its own kind of cash flows and revenue into the AI race. And so I am personally most interested in Meta because I think that it represents the aggressive AI investment side, and it's going to be really nice to contrast that with Apple tomorrow, which has taken the almost seemingly polar opposite approach in terms of being a little bit more conservative, attempting to kind of play kingmaker and sort of watch the horse race and then pick a winner, halfway through it. Remains to be seen. Maybe both strategies can be successful, but they're certainly different approaches, but they're also starting from different places, given that Apple already has a tremendous device installed base that gives it a little bit more leverage than maybe a company like Meta that is entirely software-based until recently and maybe a little bit more exposed to the kind of disruptions that AI presents.
And just quickly, we've only got a minute to go now, Alex. Obviously, we've seen some companies being rewarded for their good earnings today. Anything stand out to you about the positioning ahead of a very consequential afternoon?
Oh, that's a good question. I mean, it's hard not to realize and see the Nasdaq's outperformance today. So much of the strength continues to be semiconductor driven. Seagate stands out today. And then don't sleep on a name like Bloom Energy. These AI infrastructure stocks continue to drive the narrative. Well, who's paying these companies? It's the companies that we're about to report on in the next couple minutes.
Yeah, Seagate, Bloom, Visa, T-Mobile, Starbucks, all higher today. Pretty flat on the S&P 500. Looking for some direction from these major companies this afternoon. We're just minutes away. Here's your bell. So as Alex pointed out there, we had the Nasdaq 100 outperforming as we did have some of these tech earnings very much pulling their weight. The chip stocks were rallying once again after taking a breather in recent sessions. The SOX was up 2.5%. You had Seagate up 11.5%. A lot of the memory names actually putting on some nice gains as well, particularly as we head into Samsung's earnings tonight. That's going to be the next big one to drop as well post these Mag 7 earnings. Of course, we did have a split picture across our Mag 7 cohort today. The S&P 500 flat as a pancake as we go into what is going to be a very consequential afternoon here, as I mentioned, and this is going to really dictate the direction of the market for no doubt days to come here. The Dow Jones shedding 280 points, down 0.6%, and it was a similar percentage point decline there for the Russell 2000 as we did see higher interest rates, or I should say higher yields, excuse me, the 2s, the 10s, the 30s rising today, particularly as Powell's press conference went on. We learned about some of those dissents as well around their opposition to the easing bias. We've got Meta's numbers hitting the tape right now. So, Marley, I'll get across to you with those numbers.
Yeah, we've got Meta coming across right now. Let's take a look at EPS here, coming in at $10.44. for the quarter right now for Meta. They were looking for somewhere around 670, 680. There was a bit of a wide range here in terms of the EPS forecast, but whatever it was, it is a beat there. For revenue for the first quarter, 56.31. The expectation was looking for about $55.5 billion, so a beat there as well. Their family of apps operating income at $26.9 billion. The street was looking for $24.26, a beat there as well. Reality Labs had an operating loss of $4 billion. That is less than the expected loss of $4.77 billion. Their family of apps we covered, and as we go with their guidance coming forward, they are giving some guidance here. Second quarter revenue, $58 to $61 billion here is what they are projecting. The estimate was looking for $59.56 billion, so right in the mid-range there. But they've got a beat on the top and the bottom line here. Here comes the fiscal year CapEx number. This one we've been waiting for, $125 to $145 billion. That is up from the $115 to $135 that the company previously projected. So Meta planning to spend more. And as that one came across, we did see a slight dip to the downside here, but sort of around the, as we move lower, now we're down 5% as those CapEx numbers started coming across here. Alex, want to bring you into the conversation here and digest some of these numbers we're seeing. It's a strong quarter in terms of the top and the bottom line beats here, but that CapEx number was keenly in focus, and it's even higher.
Yeah, so far as I'm sort of assessing everything as it's happening, it looks like you got one unchanged name, you got two higher, and you got one lower, starting with the one that's under pressure here in Meta. They talked about CapEx. That's, the big highlighted screen. It's what everybody was refreshing for. You mentioned the numbers. They raised both bounds $10 billion, having previously seen 115 to 135. They now see 125 to 145. So when I see that, it's not as aggressive as it has been, but it continues to show that the direction of the spending is going one way. That said, the revenues are still pretty impressive. When you look at their current quarter guidance, it's not necessarily a beat. I would call it kind of in line. So they provide $58 billion to $61. Street estimates were for a midpoint of around 59.5. So slightly below it, sort of like an inline miss, if you would say. This stock initially moved lower, it moved back to unchanged, and then it's plunged now on a relative basis as it's towards its lows after hours here, which is down about 5%, as you say. If you were going to choose, hey, if only one of these names was going to be lower by a meaningful amount, Meta's the one. But the reason it's lower is because it keeps spending. I don't know that we got more answers without leaving. I guess we still have just as many questions as to what the market really wants to see from some of these companies as we do answers.
Yeah, and another thing to add here, too, they also reported that they got an $8 billion plus income tax benefit that they recognized here in the first quarter. So perhaps skewing some of those numbers and why leaving our second quarter guidance more in line. But Sam, Alex raised a really good point here that we are spending more now at Meta, but we're not necessarily realizing perhaps as much as the street wanted what that spend is going to and seeing that monetization, because I know in all the conversations we've had with guests, that's what everyone is looking for right now.
That's exactly what we were speaking to Angela Zeno about 24 hours ago from CFRA, Marley. I mean, we come into every quarter saying we want to see the monetization. We want to see the ROI and all of this, because Alex is right. And Alex and I have been talking about it all day as well. This company is spending a ton of money and it's wiping out a lot of its free cash flow. And that's really been something that the street has been quite focused on. And as Angelo said yesterday, I mean, Meta has really the most to prove because it has the most upside potential. But he also said it's because they don't have the cloud like the others that they do need to see. That's the street, the monetization in a name like this. Look, as far as the other numbers are concerned, look, it had quarterly results that came in pretty good last time around, and then we subsequently saw that 10% pop. But that didn't translate into sustained gains because it did drop, 30% over the course of the last 3 months. It has come full circle coming into this report and actually was up 2% heading into this week. But depending on what happens on the call and if they can give any update on some of this monetization, it's going to be very interesting to see what the reaction will be and if it will last.
All right, and I want to pivot over here to Alphabet to talk about Google here. Meta actually plunging more, too, down about 6.5%. But let's move on to Alphabet. They're higher, up by more than 3%. They've got Q1 revenue of $109.9 billion. That beat the estimates looking for $107 billion. Their revenue, excluding traffic acquisition costs, was about $94.67. That also topped the estimates looking for about $91.5 billion. Operating income coming in at $39.7 billion. That also topped estimates. Their Google Cloud revenue is $20.03 billion. That beat the estimates. That's a very important metric here. YouTube advertising revenue was $9.88 billion. That was slightly below the estimates, looking for $9.97. But Google advertising revenue totaled $77.25. That exceeded the estimates, looking for $76 billion and some change. Google services revenue reached $89.64 billion. That one also topped estimates here. You know, as we're looking at Google here, they're also releasing some commentary here. Their strongest quarter ever for our consumer AI plans. We're seeing these shares lift up here. Their number of paid subscriptions has now reached 350 million users. They're saying AI driving usage and queries at an all-time high here for Alphabet as we're looking at these numbers, but saying that, you know, our consumer AI plans driven by Gemini gave them their strongest quarter ever. I mean, it's quite a statement here for a company that we were waiting to hear from, and the street likes it. We're up 4%. Alex, what are your thoughts here as we're digesting these numbers as they come up?
Yeah, Gemini growing 40% quarter over quarter. Alphabet's coming in this race. Like, they are making big moves and in some ways have the easiest access point to the everyday person, the person who isn't necessarily going out of their way to adopt this technology. Alphabet is almost a handshake into it as they've sort of embedded this technology within traditional Google search. Once you're comfortable there, you start interacting with it. You maybe consider just downloading the app directly. The branding is right in front of you in an everyday way. Yeah, ChatGPT, Claude have become household conversation points, but not in the same way that Alphabet and Google are. So the fact that Gemini is seeing that kind of growth, I think, is proof that their approach is working. I also noticed that their other income reflected a net gain of $37.7 billion. So, I mean, that's incredible. That's essentially just their almost like venture capitalist arm of what they do. So they're investing in the right places. They're showing signs of winning. And right now they're putting the market on their back, because when you look at what Meta is doing, plunging, it's putting pressure on things. This Alphabet move does more than undo that and actually provides a pretty nice upside here. And that's why you see equity futures, both NASDAQ and S&Ps, higher than where we were when we closed the bells.
And Sam, I think as I went through all of those revenue numbers, I excluded EPS here. Q1 EPS coming in almost 2 times what the consensus was, coming in at $5.11. The consensus was for about $2.67 here. Also an important note about Waymo. We continue to have this autonomous conversation. Waymo surpassing 500,000 fully autonomous rides a week. I mean, this report is chock full of things for the street to like.
Yeah, and it's a reason, and I think it's further confirmation, Marley and Alex, that this is why it's the best performing Mag 7 stock over the last year. I mean, it came into this week with an all-time high into the print. The bar was high. I mean, some of the analysts were saying it doesn't have as much upside potential because of that, so much as it has been priced in, but it's cleared the bar and it's getting a very good reaction right now. I mean, Angelo was speaking about this one as well over at CFR Ray yesterday about how he believes, and this is, I think, quite consistent among a lot of the analysts, that this is one of the best positioned of the bunch, and the stock is being rewarded. It's got a lot of praise for Gemini, to Alex's point. It's expected to grow, he believes, into its rich valuation in the coming quarters, particularly because of the investments around Anthropic as well. And then, of course, you have Wedbush, who's particularly bullish on this, well positioned to grow across its vertically integrated AI flywheel, spanning Gemini 3, custom TPU, silicon, and also the hyperscale cloud business. So obviously watching that cloud growth, watching that Anthropic partnership, wanting to see, obviously, how the Gemini infrastructure will translate into real revenue. But yeah, I mean, obviously a lot to like about this report. So let's continue to watch this reaction tomorrow and see if it lasts as well.
And Alex, thoughts on the reaction and the numbers we've gotten from both of these names? It's a sort of a tale of two very different stories here.
Yeah, I think the things that I was concerned but also interested in how the market was going to interpret in terms of Meta. I think we've started to get a little bit of answer. We're not rewarding aggressive spending if you can't show as to what it's actually returning to shareholders. So we might be, kind of approaching one of those year of efficiency type pivots for a company like Meta if this continues to be the reaction. Too early to say. But when it comes to being able to show results, that's what Alphabet was able to do today. They were able to show, hey, look, our products are showing growth. Oh, and by the way, our investments are showing incredible growth. Almost $37 billion worth of investment. Oh, and all of our core businesses, they're still growing in double-digit, percentage terms. YouTube ads up 11%, Google services up 16%. This is a company that quarter after quarter is growing, in this case, 22%. And the numbers are just astronomical. 109.9, almost $110 billion in revenue and a high margin business. I mean, we're talking about companies that they really don't have any rivals. They're kind of ones of ones in many ways. And if you had to choose where you wanted strength, Microsoft is a little bit lower now. Amazon is struggling a little bit. Alphabet is doing its best to try to put the market on its back.
Yeah, and in addition to all of that, raised its dividend 5% over at Google to 22 cents per share. Alex, thanks for being with us to take a closer look there at those earnings that just came across for us. That's Alex Coffey, co-host of Next Gen Investing. I do want to welcome George Tillis back to the show, though, to take a look at the other two names that are reporting. Alex just mentioned Microsoft struggling a little bit. So let's go to Microsoft first, take a look at those numbers. We are seeing Microsoft down more than 2.5% right now. So let's take a look at the fiscal third quarter numbers. EPS coming in at $4.27. That is better than the expectation. Revenue coming in at $82.89 billion, also better than the estimates, looking for $81.46. Their operating income, at $38.4 billion. The estimate was for $36.9. They're also saying that their Azure cloud revenue grew 39%, which is slightly better than the expectation for 38.2% there. That's a very important metric here. Their AI business surpassed $37 billion annual run rate. That's up 123% year over year. And their cloud revenue reached $54.5 billion. That exceeds the estimates for $53.78. But again, still seeing some pressure here on this name. We are seeing their 365 consumer cloud revenue up 33%, LinkedIn revenue up 12%, Dynamics 365 revenue up 22%. Their cloud revenue we've already covered here. So George, as you're looking at this, I'm seeing a slight decrease in their Windows OEM and devices revenue. But what is sticking out to you here as this downward move here? I know they're betting big on cloud, on AI infrastructure, on agentic. Is it just still concerns tied to that?
I think so. I mean, look, I think it's a little too early to make a case for what's going to happen tomorrow with Microsoft. I think the conference call is going to be important because, I mean, one of the things is if you look at the intelligent cloud revenue, 34.7 versus 34.3, it is a beat, but maybe not a marginal beat or a sufficient beat for institutional investors to really take hold of the stock. It's tough to find really a case for right now why it's down so much. But again, if you look at Q3 productivity and business process revenue, 35 versus 34.4, these are all beats. But again, based on what's going on in this environment, they're incremental beats. So, like I said, I think what's going on with OpenAI and that relationship is going to be really focused on in the conference call because they're not reporting anything in that regard, at least right now.
And Sam, we've had this conversation a lot about some of these bigger names and how the bar is better than good at a minimum. Is this just a case of some headlines potentially putting a drag and the bar just being so high?
Yeah, it's interesting because obviously given the multiple compression, George and I were speaking about this earlier, the bar had been low as far as the folks over at CFRA were concerned because it had to show a clean story. I mean, they can gain from pushing back on this whole SaaSpocalypse narrative. So I think the conference call is going to be very interesting to see how they address that because, yeah, as we've mentioned, as far as the stock performance is concerned, I mean, under pressure since October, shares back to levels before last quarter's report, yes, but then it took a 10% drawdown, another, almost 17% or so from all the AI disruption fears. And Jay Woods have been pointing out that that's not because the story is broken, but maybe because some of the expectations have got ahead of reality. So I think, the Azure growth is encouraging. I think that's positive, particularly because that was likely to come in the high 30s, which it did. That has been good. It hasn't been strong enough, actually, to prevent the sell-off that we've seen in the company, in the stock, which has been interesting. So that'll be one to watch moving forward. But as we've all been saying as well, the other metric, Copilot, are we starting to see real revenue there? Because that's a clear and very important read on enterprise as well, particularly in this whole software story.
Yeah, and I want to pivot over to the last name here, Amazon, and make sure we have proper time to take a look at them, too. Initially, we saw a positive move. Now we're down more than 4% here for Amazon, so let's take a closer look. EPS coming in for the first quarter at $2.78, far better than the expectation, looking for about $1.62. Their net sales, $181.52 billion. That's also better than the $177 plus that was expected there in terms of their sales. AWS, this important metric, AWS net sales, $37.59 billion. Estimate was looking for 36.68, so another beat there too. North American net sales coming in at 104.1 billion. Estimates looking for about 102 billion. Physical stores net sales 5.79 billion. That's a slight miss. The street wanted 5.81 billion. Operating income for the first quarter at 23.85 billion. Street looking for 20.75. But Amazon Web net sales, Amazon Web Services up 28%. The street was looking for about 25.7%. That's such an important metric for them, as well as margins coming in at 13.1%. Estimates were calling for 11.7%. As far as their guidance, they're forecasting revenue between 194 and 199 billion. The estimate was looking for 189.15, so that range may be a little on the lower end. We're not at the midpoint with that estimate. And their operating income projected to be between 20 and 24 billion. The street was looking for 22.86. So in range, but the slightly above there. George, as we take a look at this, was it just not enough of a beat? Do we have too much concern that net sales range is not where they wanted it? Operating income range is not quite where we wanted it. What's sticking out to you?
Well, I think, the operating income numbers were good. I had on the high end 21.5 billion, so they beat those numbers, as well as the guidance is growth sequential for next quarter. I do like the fact that AWS came in 28% versus 24%. I think there's going to be some insights into the Trainium 3 technologies that they're investing in. If you look at they're reporting some free cash flow decrease based on CapEx investment. So it could be a CapEx issue, at least right now in the after hours. So this one's a tough one too, because very complex situation across the board. The operating numbers look very good. AWS sales look good. I think the relationship with Anthropic is thriving for Amazon. That's something I think is a catalyst for the business. That's why I suggested actually it was trading, near the all-time highs, if not the all-time highs, as of late. But nonetheless, it could be a function, like I said, of CapEx guidance was a little bit high, and that's creating a little bit of a drag on free cash flow, and that's why we're seeing a little bit of a drift lower in Amazon after hours.
Yeah, and Sam, I'm just running through these metrics here and the conversations we had about Amazon, even just this morning, on what was so important here. And we've got beats, we've got margins coming in better than expected. And then the AWS up 28%. They hit $37.5 billion, a little bit more than that in terms of sales. It's the fastest growth AWS has seen in 15 quarters, but still we're down 3.5%.
Right, yeah, and Gabelli Funds made a really interesting point today when I was speaking to them about this one. I mean, this is a very big, complicated business to some degree, hard for everything to hit on all cylinders every quarter. So, yes, good metrics and a pretty good report at the surface, but they also made the point that the cloud acceleration that we were likely to see, as we've now come across in the AWS numbers, they seem like had been pretty much pre-traded. I mean, it's sort of baked in at this point because obviously we know that AWS has remained strong. So that's interesting. Obviously, the CapEx got punished last time around with that $200 billion. It has since got rewarded. Suffice to say, because it has signed customer commitments here, as George pointed out, that collaboration with Anthropic as well. I mean, most analysts have been pretty bullish and positive positive heading into this, with most with a buy rating. So, yeah, going to be very interesting to see what they sort of flesh out on this call as to, why we've seen this kind of reaction and then what happens tomorrow, Marley.
Yeah, absolutely. And George bringing up a great point with the CapEx and also one of free cash flow falling to $1.2 billion for the trailing 12 months. The company commenting that decrease was driven by a year-over-year increase in property and equipment purchases. So perhaps also some concerns there that may weigh on the expenses. Also saying their guidance sees unfavorable FX impacts of about 10 basis points there as well. That just coming across the wire here. But now just about a 1.5% to 2% move to the downside for Amazon. George, really appreciate you being with us to take a closer look at these earnings as they come across the board. Amazon trying to get back into positive territory. We're down about 1.25%, though. Microsoft down 1.8% right now. Meta down 6%. And Alphabet holding on to its gains, up about 3.5% on the heels of what were beats across the board for all of these names. Coming up next, we are going to close out our show with our final takeaways and what we are watching for tomorrow. Market on Close will be right back.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets, with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Market on Close. I'm Marley Caden here in Chicago alongside Sam Bottis at the New York Stock Exchange. Here's some final thoughts on the session today. No shortage of things to choose from today, but of course the Federal Reserve announcing it is leaving its key interest rate steady, but with a level of dissent we haven't seen since 1992. The FOMC voted 8-4 to hold the benchmark funds rate in a range between 3.5% and 3.75%, which was what the market was expecting. Governor Stephen Miron, as he has done since joining the central bank back in September of 25, dissented in favor of a cut. The other 3 no votes came from regional presidents from Cleveland, Minneapolis, and Dallas. They said that they agreed with the hold, but, quote, did not support the inclusion of an easing bias in the statement at this time. Jerome Powell also added that he had long planned to retire, but is staying on as a governor only because of recent events. He did say how long he stays on for, though, is TBD. Kevin Warsh's path to lead the Fed got one step closer to completion today, though, as the Senate Banking Committee voted this morning to advance his nomination for a final confirmation vote in the Senate. That is expected the week of May 11th. And also PayPal reportedly making a major strategic pivot this afternoon, officially separating Venmo into its own standalone business unit for the first time. Now, this is according to a report from CNBC. The move is part of a broader 3-segment reorganization that investors seem to be cheering. PayPal jumped as much as 4% after the story was released. Now, by carving out Venmo, PayPal could be preparing the asset for a potential sale, with reports suggesting that rivals like Stripe are already circling the payment app. Venmo has nearly 100 million users and is viewed as arguably PayPal's most valuable standalone asset because of its growth prospects. Analysts have long said it is a key target for potential acquirers, and it could attract a premium valuation. PayPal closed the day up more than 2.5% higher. Sam, what caught your eye today? I'm curious because we had a lot of options.
Yes. Yeah, and so my macro brain went with the data. We got a bunch of it this morning. Marley, core goods seen as a proxy for business spending, up 3.3% compared to 1.6% in February. So this is being propelled by the AI spending frenzy, which is fueling demand for that equipment. Meanwhile, orders for durable goods also grew 0.8% last month, better than expected and snapping 3 months of declines. But while business spending helped growth last month, trade was likely a drag, and that's because the trade deficit in goods also widened more than expected. The gap growing by 5.3% to $87.9 billion. That's minus as imports outpaced exports. The other story that caught my attention today was from the Financial Times, which said investors are betting on a prolonged boom for memory chip makers amid AI demand that has led customers to lock in multi-year contracts. Now, that report talks specifically about Samsung, set to report tonight, and SK Hynix, which just reported record profits last week. Now, the report talks about the structural shift, which is actually something Seagate and the CEO talked about in earnings, and how that differs from past booms because customers are prioritizing security over price. And that is reinforcing expectations that it's shifting from the typical boom or bust cycles, that cyclicality that we've been used to in that space. But heading into tomorrow, Marley, what are you going to be looking out for?
Well, we're going to hear from our last Mag 7 name of this week. We've got Apple left. We'll even have an extended market on close to cover its earnings because they come out at 4:30 Eastern, 3:30 Central. Revenue is expected to come in just under $110 billion. That would be up about 15% year over year. EPS estimated to be around $1.92. The street is looking for iPhone revenue of about $57 billion, which would be a more than 20% increase from the year ago period. But bottom line here, Sam, Wall Street expects a strong quarter driven by iPhone strength and steady services growth. Plus, also any commentary we get on the CEO transition, I think will highly be in focus here as well. And if we might see more hardware focus for Apple. But once Apple reports, then all we have left is to wait for NVIDIA Day. But how about you? What will you be watching?
Yeah, well, we're hours away from Samsung reporting earnings over in South Korea. That's tonight. So we're expecting a solid print from the tech giant. Earlier this month, it forecast a record quarterly profit amid strong demand for AI chips. Its preliminary guidance projected profits to come in at $37.8 billion, more than eightfold from a year ago. We already heard from its local rival, SK Hynix, which saw operating profit grow fivefold compared to a year ago. So let's see what those numbers tell us tonight. If we see some follow through in the memory names here in the US tomorrow, we'll also be getting the decisions from the ECB and the BOE tomorrow morning as well, Marley. And that's going to be very interesting because they are dealing with rising price pressures and growth concerns. And a lot of the market participants have actually been starting to price in hikes from those central banks just because of some of the stagflationary worries in those parts of the world. So it's going to be very interesting. I think the expectation is they're likely to take a cautious approach, but the language is going to be key. I'll be watching FX markets and global fixed income tomorrow morning as well off the back of all of that.
And of course, the response to these earnings and the calls, because still looking for some direction here. We could see a change in direction in any of these four Mag 7 names. Alphabet still trading higher. Meta still down more than 5%. Amazon only down about 1.5%. Microsoft about the same. So we could see some direction moves there depending on what's said on the calls. But we will have that for you, of course, in the morning. That is going to do it for us today on Market on Close. For Sam Bottis, I'm Marley Caden. Be sure to download our Schwab Network app, available in the App Store for free, and tune in 24/7 to schwabnetwork.com. We hope you have a great rest of your Wednesday.
All right, guys. Just going to do a little recap of what we were kind of looking at. Good breakdown from everybody from the Schwab Network. I love watching them, honestly. It's great. They have the best news, the best literally everything. They have the best everything. They get rid of all the political BS, and it's just strictly news about stocks and what those companies are doing. It's really important, honestly, for me. It helps get rid of a lot of that, like I said, BS, all that little white riff-raff and noise talking from everybody else about their personal opinions. I could really care less about people's personal opinions, honestly. When it comes to trading, personal opinions don't really matter too much for me. Because it's just how you feel, right? It's not data, it's not fact, right? It's not a collection of numbers, right, to get to this conclusion. You know what I'm saying? So anyway, that's why I really like them. It doesn't really look like the SPY moved too much. Looks like we're literally sitting right where we were a little bit before close. Let me see, zoom in really quick. Where were we at close? Like right here. 7-11. 7-11. Looks like we're right there right now. Literally 710.93 is what I got on the chart. But yeah, so I kind of agree with. I was listening to Mo a little bit earlier, and I agree with what he said about the Fed chair. What's the day look like today? Looks like we had some consolidation, quite a few. Consolidation, nothing too crazy. Yeah, I agree with what Mo said, basically about the Fed. Said that we're not going to be cutting rates and that we shouldn't, which I typically agree with. Right now, for the current moment, in the current political, or not political, but the geographical environment that we're in right now, obviously with Iran, we had the Maduro situation, and Venezuela, and then obviously the Strait. You know what I'm saying? The Strait's been kind of closed. It's been back and forth and whatnot. So there's just lots of geopolitical risks going on right now, towards making it a little bit harder on the consumer, on us, for oil at least. So I don't know. The whole oil business in general is really wishy-washy for me personally, because a lot of it, what did Mo say the other day in one of his videos? I don't remember exactly what he said, but he said he was still kind of learning the new way on how oil is being, I guess, incorporated into our everyday life, right? So obviously we have our refineries, and then we have our rigs, right, to where we go and chill out the oil from the ground. Obviously you can get it from the ocean, from our ocean floors, obviously in the ocean, right, or on land. And so a lot of those have to do with, in my personal opinion, when it's coming down to the consumer, from there, obviously, they get sold to the refineries, and the refineries sell it at a rate for whoever company, like Chevron, Valero, or you take your pick on whatever company. But like I said, I think it really kind of has to go down to the refineries, of why we don't see when oil prices go up really high to when they end up going down. Like looking at future oil, obviously when you're looking at crude oil and stuff like that, a lot of people are really quick to keep those elevated prices high. Yeah, that's what Mo said. To keep the gas prices high at the gas pump, and then obviously really hesitant when it comes to bringing those prices down when oil prices go down. And I think it really has to do with the middleman, where you get it directly from there, from the refinery to the transportation, and then to whatever storefront or whatever oil company is, doing those things. And I think, like I said, it has to go kind of down to the middleman, which is, in my opinion, refineries. We don't have that many refineries in the United States. A lot of them are overseas. Not saying that we don't have any, but we have very little. So I think that has a huge role on why we don't see gas prices going down as fast as we see crude oil going down. So that's kind of my little tidbit about that. Obviously, there's way more stuff involved in all those things, but that's my little 2 cents about that. Going into the market and the close here really quick. Just going to see where we closed on the daily, which is pretty much flat. We closed pretty much flat. Alright, so here's the daily. It's sitting right here, right on my red line. It closed above. It's real iffy for me right now that I'm looking at this. This candle pretty much closed above the 5 to end the day. Post market, we're a little bit down, but we're still technically in the channel. Just look at the 15 a minute here real quick. Yeah, man, it's real tough. It's real tough to think on where we're gonna go. We had that huge rip up, huge rip down, and then bounce back up. We might come all the way back up to pre-market gap again and fill here. We're just gonna kind of have to see. Man, dude, there are so much other things that I wanted to say, and I just can't think of them right now at this very second. Anyway, that's pretty much all I got for you guys here today. You know, rewatch this. Go back if you want to watch the FOMC meeting. I got that going on right there. And then obviously we had why do I have 2 live streams? It's a little weird. I didn't even notice that until just now. Anyway, that's all I got for you guys. I'm going to be paper trading tomorrow morning. At like 6:30 my time. That's around 9:30 EST. So I hope to see you guys there. And also, man, let me tell you, the Earner Plus tier for the monthly and for the lifetime, Mo said that the discount is ending tomorrow. So you got one more day. I thought it was ending today. I guess it's not. It's ending tomorrow, the end of the month. So if you guys want to get in, please get in right now and join us on the financial freedom journey. Also, I'm going to be moving over just to the Earner Plus tier for a little while. And I'll occasionally have a live stream out there for some of the earners and some of the other people in the Discord to follow along to as well, probably maybe once a week. I'll have something out for everybody to join. But if you haven't already, follow me on YouTube, follow me on Twitch, follow me on Kick. And if you guys are looking to upgrade, all you got to do is just click on my YouTube page. You can, if you're on desktop, you can scan this little QR code right here. If you're on your TV, I got that QR code up top above. And if you don't even want to deal with any of that, you don't want to pull out your phone, or if you're just on your phone, you can click right here on this link right underneath my description, or you can just click the description and you can see my link right here. My links to financial freedom. This is my digital business card, so it has everything in there. You can just click here, it'll pop on up and it'll take you exactly where I am right now. Hey, that's me. You got the plus tier, you just click on this guy. This is for the monthly, and it'll take you right here to the checkout page, and then you just click on this guy and it'll take you there. If you're looking for the lifetime, boom, click the lifetime, and this guy will take you right up over here, and then you're going to want to use that discount code. So I don't know, I didn't mean to exit out of that, but you're going to want to use that discount code once this loads here really quick. Use the discount code EARN to get 40% off and get grandfathered in for life. And you won't have that price increase. So price increase will be $160 a month. I think if you go to the monthly right now and you type in the code EARN at checkout, where's it at? Add promo code. You're just going to click on that guy, right? It's going to pop up. You're just going to type EARN. Boom. Apply. And it will apply that 40% off for you, and then your monthly payment will be $197 per month for life. So you'll get that for life. And you'll be at the highest tier in the Discord. You'll get everything. You get the bread bot incorporated into your trading view. You'll get the live streams every Wednesday. Also the crypto live streams that Mo's going to be doing too as well on Zoom. So there's literally like zero delay, almost like none. So look forward to that. Also, you got the twice a week lives, Tuesdays and Thursdays at 2 p.m. EST. Also, you'll be getting the Here, I'll just pull it up real quick for you guys to actually see too as well. So we'll go to the Discord here. Open Discord. Just to kind of show you guys exactly what's kind of going on if you don't already have it. Boom, you're going to come over here to our Dealio, and then you'll see right over here on our left-hand side, you just scroll down a little bit. You'll have your Earner Plus channels. You get your own inner circle chat. So everybody who's an Earner Plus tier, you get your own kind of chat. Obviously, you get Mo's lives right here for the plus tiers, right? 0 DTEs. And then also you got your other experts in here as well. Andrew, one of our other experts, Dr. Stock, River Edge Futures. This guy's trading futures. You know, Tech Goat, Front Options, one of our other guys. Money Mentor. You know, all these people are coming. Me right here, I moved all my stuff over in here so you can see everything that I got going on. You know, we do news. I do White House news, everything like that. I also, you know, drop my lives. I do my charting. We have the earnings that we were talking about today, dropping some of that. Just kind of letting you guys know. And then obviously, you know, you got my technical analysis breakdowns. Boom. You know, like this guy, what I was looking at, what's happening. So if you guys haven't already, dude, take the leap. Take the leap. It is worth it. We have lots and lots and lots and lots and lots of stuff in the Discord. So if you guys are ever interested, like I said, you can scan the QR code or you can use my digital business card where it gives you everything that you need to do or everything that you need to get all set up and stuff like that. And if you guys had any questions, feel free to message me in any of the chats and let me know. But I'll see you guys in the morning. I hope you guys have a great day. Take it easy. Peace.